fundamental component of business intelligence analysis. Its purpose is to provide a clear and structured view of the organization's financial health, identify potential financial risks, and evaluate the sustainability of its business model. One of the primary objectives of financial mapping is to assess financial stability. This involves understanding whether the company generates consistent income, maintains a balanced cost structure, and operates on a financially sustainable basis. Another key objective is identifying liquidity risks. Liquidity refers to the company's ability to meet its short-term financial obligations, such as supplier payments, salaries, and operating expenses. An organization may appear profitable on paper, but still face liquidity challenges if cash flow is insufficient. Financial mapping also focuses on evaluating earnings quality. This means examining whether reported profits are supported by real cash flow and sustainable business activity, rather than accounting adjustments or one-time events. To conduct this analysis, several financial parameters are examined. First, cash flow is analyzed to understand how money moves into and out of the business. Positive and stable cash flow is a key indicator of financial resilience. Another important parameter is debt and liabilities, which helps assess the company's level of financial obligations and its ability to service them. The analysis also reviews profitability by product or customer, allowing decision-makers to identify which areas of the business generate the most value, and which may be underperforming. Capital structure is another important factor. This refers to the balance between equity and debt financing, and helps determine the company's overall financial leverage. In addition, the analysis examines supplier and customer credit terms, which influence working capital and cash flow timing. Another key component is the comparison between financial forecasts and budgets versus actual performance, which helps evaluate financial planning accuracy and management control. During the mapping process, several common weaknesses may emerge. For example, the organization may demonstrate a lack of budgetary control, where expenses exceed planned budgets, or financial planning is not closely monitored. Another weakness is high levels of debt without adequate coverage, which may create financial pressure if revenue declines or interest rates increase. A company may also report accounting profit without corresponding cash flow, which can signal underlying financial issues. Additionally, high fixed expenses can reduce financial flexibility and make the company more vulnerable during periods of declining revenue. Finally, financial mapping may reveal several red flags. One significant warning sign is persistent negative cash flow, indicating that the business consistently spends more cash than it generates. Another red flag is dependence on owner capital injections, suggesting that the business cannot sustain itself through normal operations. Additional concerns may include mixing personal and business funds, which can weaken financial transparency and governance. Another warning sign is revenue growth without corresponding profit growth, which may indicate inefficient cost structures or aggressive pricing strategies. Lastly, discrepancies between management reports and formal financial statements can raise concerns about financial accuracy, reporting quality, or internal controls. Overall, financial mapping provides decision-makers with a deeper understanding of the company's financial condition and helps identify potential risks that could impact long-term stability and performance.